There's a guy who started investing at 42. No trust fund, no inheritance, just a regular salary and a credit card he'd been paying minimum on for 6 years. By 55, he had $780,000 in index funds. Another person I know was 38, working retail management, living paycheck to paycheck. Started with literally zero in assets. Today, at 49, she's got $412,000 invested, and she's on track to retire at 57. Then there's the inverse case. A friend of mine made 6 figures in his 30s, bought individual tech stocks, traded options, felt like a genius during the bull run. By 41, he had less money invested than the retail manager. He kept chasing the next play, the next edge, the next alpha. His account balance looked like a heartbeat monitor during a cardiac event. Up, down, flat, repeat. Here's the uncomfortable question. If you're starting from zero right now, in 2026, which one of these people are you going to be? I'm going to walk you through the exact playbook I would use if I woke up tomorrow with nothing. No stocks, no bonds, maybe some debt, and a job that covers the bills but doesn't leave much after. This isn't theory. I've got multiple hundreds of thousands of dollars invested using this exact framework. I've spent 10 plus years running my own business, surrounded by accountants and fiscal lawyers who taught me how money actually moves through the system. The strategy we're covering today is designed specifically for the economic reality of 2026. Interest rates that aren't zero anymore, housing costs that look like typos, an AI arms race that's changing the job market faster than anyone wants to admit. But here's what nobody tells you. This environment actually creates a cleaner entry point than we've had in a decade if you ignore the noise and focus on the math. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan. And I only ask for your email to send the reports, so I don't store any of your financial data. Link in the description. Think of wealth building like filling 3 buckets. The first bucket has a hole in the bottom. That's your debt. The second bucket is your foundation. That's cash. The third bucket is your engine. That's investments. Most people make the fatal mistake of trying to fill bucket 3 while bucket 1 is still leaking. They think they can outrun a hole with more water. You can't. The math doesn't work. This metaphor is going to keep coming back because it explains why sequencing matters more than almost anything else. Let me tell you about bucket 1, the one with the hole. In 2026, the average credit card interest rate is sitting around 24%. Some store cards are pushing 29%. If you're carrying $5,000 on a card at 24% and making minimum payments, you are going to pay back nearly $10,000 over time. That's a 100% markup on money you already spent. Meanwhile, people ask me if they should buy an AI stock or a crypto coin while sitting on this debt. Here's the thing. Paying off that credit card is a guaranteed 24% return. Show me anywhere in the stock market where you can get a guaranteed 24% return without risking total wipeout. You can't. It doesn't exist, but we keep the debt around because it feels manageable. It's just a line item, like Netflix, like your water bill. We normalize it. There's a psychological trap here that most people miss. Debt creates a scarcity operating system in your brain. When you owe money, you're afraid to take career risks. You won't ask for that raise because you can't afford to lose the job. You won't move cities for a better opportunity because the monthly payment has you locked in place. The true cost isn't just the interest rate. It's the opportunity cost of the life you're too scared to live because you're shackled to Chase Bank. This is where the psychological shift happens. Clearing debt isn't just a financial move. It's a mental unlock that allows you to play offense later. I knew someone who had $18,000 in consumer debt spread across 3 cards. Average interest rate around 22%. He used the avalanche method. Listed every debt by interest rate, highest to lowest, threw every spare dollar at the highest rate while paying minimums on the rest, sold his second car, downgraded his apartment, canceled subscriptions he forgot he had, treated it like a genuine emergency, not a background hum. 12 months later, the debt was gone. The month after that, his entire mindset changed. He started negotiating harder at work. He took a certification course he'd been putting off, Within 6 months of being debt-free, he got a promotion that added $14,000 to his annual salary. Recurring, forever. The debt wasn't just costing him interest, it was costing him confidence. Now you might be thinking, okay, debt's gone, time to buy some index funds. If you do that, you're statistically likely to blow up your plan within 18 months. Why? Because life happens. The transmission goes out. You need dental work. A family emergency pops up. If your money is tied up in stocks and the market is down 15% when your car dies, you have exactly 2 options. Sell at a loss to fix the car, locking in that 15% haircut permanently, or don't fix the car and lose your job because you can't get to work. Either way, you just destroyed your compounding before it even started. This brings us to bucket 2, the foundation, the sleep well at night fund. People hate this part because cash feels like it's doing nothing. Influencers will scream at you that inflation is eating your money, that you need to be fully invested at all times or you're losing. But cash isn't an investment at this stage. It's insurance. It's a psychological buffer that prevents you from making catastrophic decisions under pressure. Let me show you the math of having a buffer versus not having one. 2 investors. Investor A puts everything into the market. Investor B keeps $12,000 in a high-yield savings account earning 4%. The market corrects by 20%, happens on average every few years. Both investors lose their jobs. Investor A has to sell stocks at the bottom to buy groceries, locks in the 20% loss permanently. Investor B uses the cash buffer, leaves the portfolio untouched, waits for the recovery. By the time the market bounces back, Investor A is broke, Investor B is whole. The math favors the person who never has to sell at the wrong time. There's something deeper going on here. When you have 3 to 6 months of expenses sitting liquid, you walk differently. You negotiate differently. You're not desperate. This prevents emotional decision-making, which is where most investing plans die. People sell when things are red because panic. They buy when things are green because FOMO. A cash buffer creates a gap between stimulus and response. It allows you to look at a market crash and see a buying opportunity instead of a catastrophe. Without this buffer, you're trading with cortisol and adrenaline. The market will bankrupt you for that. So here's the protocol. Calculate your bare bones survival number. Rent, food, utilities, minimum transport, multiply by 3. That's the target. Put it in a high-yield savings account or money market fund. In 2026, these are everywhere. You can get 4 to 5% without thinking. Automated transfer every payday until the bucket is full. Once it's full, pretend it doesn't exist. It's not for vacations. It's not for a new phone. It's for survival. Only when this bucket is overflowing do you even look at the stock market. And this is where it gets interesting, because conventional wisdom tells you to diversify. Buy a little of everything. Some crypto, some international stocks, maybe some gold. When your portfolio is small, this is actually a mistake. Over-diversification doesn't protect you. It guarantees mediocrity. You need concentration to build wealth and diversification to preserve it. The order matters. The allure of stock picking is powerful right now. We all want to find the next NVIDIA before it runs. In 2026, you'll have AI tools promising to pick winners for you. Apps with machine learning algorithms that claim they've cracked the code. But here's the reality from the S&P scorecards. Over a 15-year period, more than 90% of professional fund managers fail to beat the S&P 500 index. These are people with Bloomberg terminals, armies of analysts, and 8-figure budgets. If they can't do it consistently, the odds of you doing it in your spare time while working a full-time job are statistically 0. There's a study I read in an SEC filing breakdown, can't remember which quarter, that showed individual investors underperform the market by an average of 4 to 5 percentage points annually. Not because they're dumb, because they trade too much, chase performance, and let emotions drive decisions. If you buy the entire haystack, the total stock market index, you're guaranteed to capture the market return. Historically, that's about 10% annually before inflation. If you try to pick individual stocks, the distribution of outcomes gets wild. You might make 30%, you might lose 50%. In the early stages of wealth building, reliability beats lottery tickets. The math says, be average, because average in the stock market makes you rich. But here's the problem with index investing. It's incredibly boring. Zero dopamine. You buy something like VTI or VTSAX and nothing happens. No earnings calls, no rocket emojis on Twitter. Psychologically, we crave action. We want to feel like we're doing something to earn the wealth. This is why people day trade or mess with options. They're paying fees and taking enormous risks just to feel involved. If you're starting in 2026, you have to hack your own brain. Accept that good investing should feel like watching paint dry. If it's exciting, you're probably gambling. Here's how I'd structure it. The core satellite approach. 90% of investable cash goes into low-cost, broad market index funds. Mix of total US market and some international exposure. This is the core. It's automated. You never touch it. Then take the remaining 10%, strictly only 10%, and allow yourself to be stupid with it. This is the satellite. If you want to buy a specific tech stock or some crypto, do it here. If it goes to zero, your financial life is fine. If it moons, great. This scratches the itch without blowing up the plan. It's like giving a toddler a toy to keep them from grabbing the expensive stuff. Your lizard brain gets to gamble, but the math brain stays in control. Now here's where most people leak 30% of their wealth without realizing it. Taxes. You can pick the perfect funds, automate everything, dollar cost average like a machine, and still hand the IRS a massive slice of your future. How? Account location. If you're doing all of this in a regular taxable brokerage account, you're volunteering to pay capital gains tax on every sale and dividend tax on every distribution. Over 30 years, that tax drag is enormous. The government gives us specific tax shelters designed to incentivize retirement saving. Ignoring them is expensive. Let me show you the numbers on a Roth IRA versus a taxable account. You invest $10,000, it grows to $100,000 over 30 years. In a taxable account, when you pull out that $90,000 of gain, you're paying 15 to 20% in capital gains. That's $18,000 to the feds, gone. In a Roth IRA, assuming you follow the rules, that entire withdrawal is tax-free. You keep the full $100,000. That $18,000 difference isn't because you pick better stocks. It's purely account selection. And if your employer offers a 401k match, that's a literal 100% immediate return. You cannot beat that anywhere. The resistance here is psychological. People say, but Tom, I don't want my money locked up until I'm 59 and a half. What if I want to retire early? This fear of locking up capital leads people to skip tax advantages in favor of liquidity. But here's the twist. Locking the money away protects you from yourself. It prevents you from raiding your retirement fund to buy a boat or pay for a wedding. The early withdrawal penalty acts as a behavioral guardrail. Plus, there are ways to access Roth contributions early if you really need to. The fear of commitment is often just a fear of long-term thinking. Here's the waterfall. Step 1. Contribute to your 401k up to the employer match. This is free money. Step 2. Max out a Roth IRA. In 2026, the contribution limit is likely around $7,000 for people under 50. Step 3. If you have a high deductible health plan, max out an HSA, triple tax advantaged. Step 4, go back to the 401k and fill it up to the cap, which is probably around $23,000. Only after all those buckets are filled do you put a single cent into a taxable brokerage. This order of operations creates a tax shield that dramatically accelerates compounding. Let me walk you through a real scenario. Meet Jake, fictional name, real math. Jake is 38, makes $65,000 a year, no assets. $4,000 in credit card debt at 21%. He follows the playbook, month 1 through 8. Aggressive debt payoff. Cuts expenses, sells stuff, throws an extra $500 a month at the card, debt gone by month 8. Month 9 through 14, he builds the cash buffer. 3 months of bare expenses is about $9,000. He saves $700 a month. Takes him about 13 months, but now he's got his foundation. By month 21, he's debt-free with a full emergency fund. Now he starts investing. His employer offers a 401k with a 4% match. He contributes 4%, gets 4% free. That's $2,600 annually. Then he maxes a Roth IRA at $7,000 a year. Total annual investment is $9,600. He's saving about $800 a month. Over 27 years, assuming a conservative 7% real return after inflation, that $9,600 a year grows to roughly $870,000. If he gets one raise of just 10% at year 5 and increases his contributions proportionally, he crosses 1 million. This isn't fantasy. It's compound interest, doing what it always does when you don't interrupt it. But here's the thing nobody wants to hear. You can only cut expenses so far. There's a floor. You need shelter, food, transport, but there's no ceiling on earning. If you want to accelerate this timeline, the spreadsheet won't save you. You need to look in the mirror and ask what you're worth in the market. We've been sold this idea that if we just stop buying lattes, we'll be rich. The latte effect. It's nonsense. You cannot budget your way to wealth on a $40,000 salary in 2026 with inflation running hot. If you focus 100% of your energy clipping coupons, you're playing defense. Defense keeps you from losing. Offense is how you win. Consider the math. A side hustle driving for a rideshare app might net you $20 an hour after expenses. It's linear. You stop driving, you stop earning. But learning a high leverage skill like data analysis, technical sales, or coding can bump your primary salary by $20,000 to $30,000 a year. Recurring, that raise counts for 401k matches, Social Security credits, and future compounding raises. A 10% raise on a $50,000 salary is worth more over a lifetime than any weekend gig. The math says invest in your primary income engine first. The psychology here is brutal because learning new things is hard. It's easier to drive a car for cash than take a certification course at night after work. We gravitate toward low friction income, but low friction means low barrier to entry, which means low pay. Everyone can drive. Not everyone can analyze data sets or manage complex projects. If you're starting at zero, you have to embrace being a beginner again. The comfort zone is where financial dreams go to die. I've seen this in my own business. The skills I learned in year 3 that felt impossible in year 1 are now the reason I can charge what I charge. Discomfort is the price of leverage. So here's the skill audit. Look at your current job. What's the one skill that if you mastered it would make you undeniable? Maybe it's public speaking. Maybe it's project management software. Maybe it's learning Python. Dedicate 1 hour a day, the time you'd spend scrolling. Use free resources. Coursera, YouTube, library books. In 6 months, use that new leverage to ask for a raise or apply for a higher tier role. A 20% increase on your shovel, your income, makes every other step we've discussed work 10 times faster. Here's what I find darkly funny about all this. The financial industry has spent billions convincing you that wealth building is complicated, that you need a guy, a platform, a secret strategy. The truth is simpler and more boring than anyone wants to admit. Kill high interest debt, build a cash buffer, fill tax advantage accounts, buy boring index funds, increase your income. That's it. That's the entire playbook. It's not sexy. It won't get you on a yacht by Tuesday. But it's a get wealthy for sure scheme, not a get rich quick scheme. I've run these numbers 1,000 different ways. Different income levels, different starting ages, different market conditions. They always point back to these fundamentals. The hardest part isn't the math. It's the psychology. Sitting on your hands while the market drops 20%, not chasing the hot stock your coworker won't shut up about. Staying the course when it feels like everyone else is getting rich faster. This is where most people fail. Not because they don't understand compound interest, because they don't understand themselves. I've been investing for over a decade. I've watched people make and lose fortunes. The ones who built real wealth weren't smarter. They were more patient. They automated good behavior and removed opportunities to self-sabotage. They treated investing like a boring background process, not a video game. If I woke up in 2026 with zero, this is the exact sequence. 1, eliminate high interest debt using the avalanche method. It's a guaranteed return, better than the market. 2, build a 3-month cash fortress to protect against life. 3, open tax-advantaged accounts and fill them in order using the waterfall. 4, invest primarily in boring, low-cost index funds. Keep the gambling to 10%. 5. Aggressively upgrade my primary skill set to increase income. That's it. 5 steps. Not complicated, just hard, because it requires patience in a world that sells speed. You're probably sitting there thinking, but what about real estate? What about crypto? What about alternative investments? Look, once you have the foundation built, once you have 200,000 or 500,000 in index funds working for you, then you can start thinking about alternatives. But if you're at zero, those are distractions. They're shiny objects that prevent you from doing the boring work that actually builds wealth. I'm not saying they're bad. I'm saying they're premature. Sequence matters. Here's the final thing I'll say. Personal finance is personal. Maybe you have a different risk tolerance. Maybe you prefer real estate to stocks. Maybe you think I'm too conservative or too aggressive. That's fine. The framework still applies. Kill the leaks, build the buffer, use tax advantages, invest consistently. Increase income. The specific vehicles can change, but the principles don't. The math doesn't care about your feelings. Compound interest works for everyone who doesn't interrupt it. If you found value in this, consider subscribing. I read SEC filings and tax codes so you don't have to. Then explain what actually matters. No courses to sell, no affiliate links for trading platforms, just the math and the psychology. Because here's what I've learned running my own business and investing my own money for 10 plus years. Lazy investing built more fortune than crypto memes. The people who got wealthy did it slowly, boringly, consistently. They didn't have a secret. They just didn't get in their own way. 3 takeaways. 1. Your debt is a negative investment with a guaranteed negative return. Kill it before you invest a single dollar. 2. Tax-advantaged accounts are the closest thing to free money the government offers. Use them in order. 3. Increasing your income has a higher ceiling than cutting expenses. Invest in skills that create leverage. And remember, in 2026, with all the noise about AI and markets and chaos, the fundamentals haven't changed. Time in the market beats timing the market. Consistency beats intensity, and boring wins.